Good afternoon. This is Brad Dennis with BIS Commodities with your weekly update for the end of September and first 2 days of October. First of all, we'll address the stocks. S&P, Dow. Beginning of the day, we saw non-farm payrolls released. Everybody was expecting a 200,000 count on the non-farm payrolls. It came in at 142,000. The initial reaction was a big sell-off in the stock market, with the Dow down over 200 and the S&P 500 down over 30 points to start out with. As the day has gone on, we've seen those those losses erased and actually are up around 30 points at the end of the day here. Now, one thing to keep in mind about the stock market, well, two things. All right, 142,000 has some in the camp that the Fed cannot raise rates because that's job growth that's too low. We're still creating jobs. We've done so for the past 67 months. So job creation is still there, and I don't think that the Fed will react to 1 month's job creation data. 5.1% is still our unemployment rate. A little disappointing on the earnings, but that's because the work weeks were a little bit lower. So in all, does this change anybody's attitude about hiking rates before the end of the year? Probably not. We'll just have to see what data the Fed wants to look at. As far as chart-wise, yes, you did close above yesterday's high. You have an outside day up, but when you look at the weekly charts, you do have lower lows, lower highs. So we'll have to probably see a little bit of a sideways trade going into the October months, waiting to see what happens at the Fed meeting on the 17th. A lot of things can happen, obviously, between now and then, but I would say that we're not going to really do too much damage to the downside until we see that the announcement out of the FOMC meeting. As for oil, it has gotten caught up in the stocks, and as stocks go up, oil goes up. As stocks go down, oil goes down, really reflecting economic growth out there. Interesting to notice that Congress is passing that we can put oil out for export, and with us putting out oil for export, it means that our production should stay pretty steady. So maybe we don't back off on the production numbers at all. This week's EIA data showed a surplus in both crude and in gasoline, so those factors will come in and weigh on this market down the road, I believe. One of the supportive things, though, is Russia getting involved with Syria, and whenever there's Russia involved in the Middle East, you do have higher prices in oil. So if that should get resolved or somehow soothed out a little bit, then you might see a little bit more of a correction. Just as crude has been a wild ride this week, you can't not pay attention to the livestock market. Last Friday we were limit up. This week limit down 2 days in a row. Today we end up $1.70. Bottom line is there's plenty of cattle out there, and packers really aren't looking for cattle right now. A lot of people are putting extra pounds on it, and it's perfect conditions for cattle right now. So they're adding extra pounds easily with this new crop coming out, and with that happening, they just keep gaining, and the discounts are getting a little bit deeper and deeper out there. It sounded like 114s were trading at some point, but that's probably on some discounted cattle out there. Boxes continue to fall off, and as of 3 o'clock today, we saw choice boxes at about 205.77. So we're still seeing that slide down quickly. Not looking at any holidays in the near future that could support that right now. So I would imagine on Monday you probably see the same thing that we saw this week. Monday and Tuesday you do put pressure on that cattle market just because nothing's moving across. And then we move over to the grains. This week in grains, we saw the quarterly stocks report. Basically, the number came out neutral for corn. It came in within the estimates that the trade had. As far as beans are concerned, beans were 191 carry out from last year. Everybody was expecting about a 205 carry out. Now, when you look at corn, corn is still $3.95 down to $3.65. 30-cent range right now, and I would imagine with harvest ramping up a little bit more next week, we start to see the lower side of this corn market, especially if the stock market stays up there. If the stock market starts to come off, guys want to go somewhere with that money, they might find the corn market. In the beans, very interesting trade, whereas on Wednesday you did have a bullish report for beans. The ending stocks coming in at 191 versus a 205 estimate. You have crude up, you have the stock market up, so you've got the macros pointing towards higher numbers out there, yet we can't get beans to break out of their range. And we saw that this week, couldn't get over 895 in the Novembers, so then we retreated down, and we were down under 870s today. So you're still a range trade on beans. Funds are short beans, and beans haven't gone high enough to have anyone have to cover their short position. So until that happens, I think you still continue to trade in this range, and actually I'd say you get a little heavy to the downside. Not seeing much of basis deteriorating yet, but are hearing of a lot better yields in the beans than people had expected. So I imagine that will weigh on them down the road. So corn-wise, corn's still very variable. Not a good enough yield on the few reports that we've had yet that would say that we have to break out to the downside at that 360, 365 area. So I imagine corn will kind of hold in there with beans kind of pacing the downside. Wheat this week, wheat was higher this week, but that was mostly due to short covering rally. When you look at wheat, we're still not competitive in the world, and our export sales on Thursday were well below estimates. So I think a short covering rally is what's happening right now. So you could trade the wheat to basis December 530 down to 480, I would imagine. So that is the wrap up for this week. End of broadcast.